Welcome to this explainer. You know, if you've been watching the markets lately, you can probably feel it. Something fundamental is shifting right beneath our feet. Today, we're going to unravel the massive geopolitical financial puzzle that's unfolding across the globe in 2026. We're looking straight at the data to understand the changing role of the US dollar, this mounting national debt, and why the world's most powerful financial institutions are completely flipping their usual behaviors.
Okay, let's just dive right into it. Following a massive 15-year bull cycle, the US dollar index has taken a pretty huge 10% dive since early 2025. And look, this isn't just your standard minor market correction. This drop is happening while the United States national debt is skyrocketing past an absolutely unprecedented $35 trillion. To really put that into perspective, we're talking about a debt-to-GDP ratio of over 123%. We literally haven't seen levels like that since the end of World War II.
So, at the exact same time the dollar is retreating, central banks are aggressively hoarding gold at the highest prices in history. Which begs the question, why? Why on earth are the most sophisticated, risk-averse financial institutions on the planet just totally ignoring the usual rules of supply and demand? And, maybe more importantly for us, what does this massive macroeconomic shift mean for your own purchasing power and your retirement savings?
Let's move into Section 1, the dollar's quiet retreat. We really need to look at the macro forces at play here.
There are a few distinct catalysts quietly eroding the dollar right now. First off, there's a huge disconnect between the Federal Reserve, which is planning to hold interest rates around 3.4%, and market investors, who are betting heavily on deeper cuts, closer to 3.0%. Then, we've got the aggressive fiscal spending from the One Big Beautiful Bill Act, or OBBBA. While the goal is to stimulate economic growth, it's simultaneously dumping massive amounts onto the national deficit. And finally, there's a very open political push from the administration for a weaker dollar, which is basically a strategy to make U.S. exports cheaper and give domestic manufacturing a boost.
Now, when you mix persistent deficits with policy uncertainty, you get what analysts are calling the Sell America trade, and it's gaining serious traction. We're seeing a broader loss of confidence in U.S. exceptionalism, plain and simple. Global investors are increasingly deciding to pull their money out of U.S. assets because of trade policy uncertainties and that rising debt we just talked about. And naturally, that reduced demand translates directly into a weaker greenback.
Which brings us to Section 2, privilege at risk. The dollar's exorbitant privilege is definitely under the microscope.
Take a look at this. A sweeping global survey by the CFA Institute brilliantly illustrates these cracking foundations. A massive 77% of financial professionals surveyed globally believe U.S. government finances are fundamentally unsustainable, and that's largely because of those crisis-level debt-to-GDP ratios. That is a stunning consensus coming from the very people who actually manage global capital.
Building on that exact point, a staggering 63% of these seasoned experts actually believe the dollar is going to lose its prominent reserve currency status over the next 5 to 15 years. It gets even crazier. Among respondents in BRICS nations, that expectation jumps to 72%, and in India, it's all the way up at 84%. The global financial community is very clearly bracing for a multipolar currency system.
Yet there is this totally fascinating contradiction here. Despite 77% saying the finances are unsustainable, 59% say investors actually haven't lost confidence in lending to the U.S. So wait, how is that possible? Well, it's a dynamic known as the TINA effect. TINA, there is no alternative. Because the U.S. still has the deepest capital markets and the strongest legal infrastructure, honestly, global money just has nowhere else to go right now.
So the crucial takeaway here is this incredibly fragile balance. On one side, we have the stark reality of unsustainable finances and a falling dollar index. But on the other, we see continued borrowing confidence driven by safe haven liquidity. As one former official quoted in the research perfectly described it, these deep capital markets currently keep the dollar afloat like the best-looking horse in the glue factory. It's an advantage, sure, but a deeply fragile one.
All right, let's move to Section 3, the sovereign gold rush. We need to look at central bank buying. If there is no immediate fiat alternative to the dollar right now, how are sovereign nations actually reacting to all this? Well, look at this staggering step change in central bank gold accumulation. Back in the early 2010s, central banks were buying around 400 to 450 tons a year. But in the post-2022 era, that volume more than doubled, pushing well past 1,000 tons. And what's truly wild is that in 2026, even with gold hitting an astonishing $5,405 per ounce, central banks are still projected to buy up to 900 tons.
Nations like Poland, Uzbekistan, and China are operating as totally price-insensitive buyers. Poland, for example, is actively marching toward a publicly stated 700-ton reserve target. Uzbekistan is leveraging its massive domestic mining operations. And China? They've been buying consecutively for over a year and a half. This just proves they aren't chasing quarterly returns like some day trader. They are strategically repositioning their national wealth for the long haul.
Let's dig into Section 4, seeking systemic safety to uncover the strategic motivation behind all this.
So what is the actual motivation behind this price-agnostic buying spree? Well, the reasons are actually quite clear and structurally sound. First, the post-2022 freezing of Russian sovereign assets proved that dollar reserves held abroad carry real confiscation risk under stress. Physical gold held at home completely eliminates that counterparty risk. Second, inflation basically halved the dollar's gold purchasing power in just one single year. So central banks are buying gold to protect their balance sheets from this rapid fiat erosion and to diversify away from being totally dependent on the dollar.
Furthermore, we're literally seeing the breakdown of the traditional 60-40 portfolio structure. 60% stocks, 40% bonds. Because bonds and equities have been moving in the exact same direction lately due to inflation, institutional allocators are losing their fixed income anchors. Because of this, they're beginning to substitute physical gold as the ultimate systemic hedge. It's providing the critical portfolio cushioning that bonds used to offer.
Which brings us to Section 5, Strategies for Everyday Investors. How do we actually protect our wealth?
We've solved the macroeconomic mystery here, but how does all of this impact your own 401k and savings accounts? Well, a purely domestic portfolio leaves your savings highly vulnerable to the dollar's quiet retreat. A weaker dollar essentially means higher inflation from imported goods, which straight up erodes your purchasing power. But diversifying internationally turns that currency weakness into an actual advantage. When you hold international assets, you gain a natural hedge. As the dollar drops, the relative value of your foreign holdings actually goes up. A really practical way to achieve this diversification is through international ETFs. Funds with exposure outside the US have been absolutely thriving. Over a recent 12-month period, the Vanguard Total International Stock ETF, VXUS, gained 32%. The European equivalent, VGK, gained 30%. And the Emerging Markets ETF, EEM, surged a massive 38%. They are dramatically outperforming the S&P 500 right now. This happens because foreign revenues translate into higher dollar values when they are repatriated back to the US.
Finally, alongside international equities, we really have to look at commodities. Since most commodities around the world are priced in US dollars, they become much more affordable for foreign buyers when the dollar drops. This dynamic drives up global demand, which, as you'd guess, pushes commodity prices higher. Incorporating commodities into your investment strategy provides another really powerful layer of defense, fortifying your portfolio's resilience against the dollar's depreciation.
I'll leave you with this final provocative thought to take away from our deep dive today. If the most sophisticated, risk-averse institutions on Earth are already actively and aggressively diversifying away from the dollar to protect their wealth, what steps will you take to protect your own financial future? Thanks for joining me for this explainer, and as always, keep questioning the data.